This one thing could be the biggest impact of the Trump administration on the housing market. Now, definitely listen through this entire video here. Steve here, own Aviator Home Loans, founder of Military Money Movement, and I'm really going to dial in today why this is such a big deal is basically returning Fannie and Freddie back to the public market. So for people, if they don't know, in 2008, the government took over conservatorship of Fannie and Freddie off of a 1992 Act and the Housing Economic Recovery Act of 2008 that authorized the Federal Housing Financial Agency to take over conservatorship to make it solvent. Essentially, Fannie and Freddie got above their skis, and the government had to come in and make it solvent. Now, why is this such a big thing? So if you look at it, if you don't know, what happens is 40% of the mortgages last year were sold to Fannie and Freddie. And these are essentially middlemen that turn the mortgages into bonds. Then they sell them to investors for the guarantee of repayment. That makes the loans available. And so in 2008 is when they took over the Fannie and Freddie, the conservatorship. And it was meant to be temporary as the companies became less risky and even more central to the housing market. Many believe the current system works well, so why change it? Well, if you look up here, there is a way to reduce the government deficit by selling shares of Fannie and Freddie, essentially bring this back to the market. Now, what would this look like for the mortgage rates? Well, the big thing to understand is if you turn it back to the government rate or to the public sector, it all comes down to this the implicit guarantee. That's what they always had right here prior to 2008. So as long as they returned it back to the public sector, but they maintained the implicit guarantee, if something were to happen, they would make Fannie and Freddie solvent, that would work. But if you even look here, both these companies have over a $254 billion line of credit with the Treasury Department. So they're already fully interconnected. So even if it went public or went back to the public sector, they're already so spiderwebbed, entangled with the Treasury Department, it would really make it tough for the government not to step back in case of an emergency or something significant happened. But it would give control of these companies to to operate privately, and it would also allow the government to hand it over and thus probably essentially quit managing everything. Okay, so according to this article here, what would happen to the rates? That's really what everyone wants to know about. And so it said here, if it turns into where it's like a utility company, they look at return on capital 10%, the rates could increase, they said almost 3/4 of a point. If it was turned over to the sector, more of a private sector, it'd be 13%. So what they would look for could be, almost a full point. But one thing I would add on this that's not in this article is there's a thing called LLPAs, low leveling price adjustments, that FHFA put on our dadgum loans that will bring these things up. So I just bring this up that this could be the number one biggest change the Trump administration does to the housing market. And it was all meant to be a temporary solution. And here we are almost 20 years on a temporary solution. And so I do believe that there is some opportunities for this to actually allow some stabilization as long as they kept the implicit guarantee. Now, when you look at over here, we use a lot of services. One of the biggest things we use is, would it impact the rates? One thing I would say is, the biggest factor of rates is, they're put together and they create mortgage-backed securities. Well, the detachment of the bond market as a hedge against inflation and other things, that's really what I believe is causing a lot more of the rates to kind of stay in this higher point. So these are hand in hand, is it going public and the bond market. So, you even look at rates are basically the exact same where they were last year. And you're going to get a steady decrease up and down over the year. But if you look, purchase applications were still up 2% last week, up 18% year over year. Refinances fell 7%, but they're still up 37%. And so you still have a lot of people moving money in the markets. And that leads to the crack in the bond market. So Jamie Dimon, JP Morgan, these, I would say, are very pontificated statements of, hey, the bond market's cracking. This is where, if we have a big issue, it's going to be in the bond market. That's where everyone's usually gone to for refuge. If the stock market gets crazy, we go in the bond market. Stock market stables out, bond market comes back, puts it in the stock market. Well, these now are starting to detach, and stock market goes a little crazy. The bond market is not maintaining a lot of the hedges that it used to do. And that is where I would say, if anything would come up, would be in the bond market that I'd be focused on in news and the future. All right, on to another news. U.S. home prices dropped in March for the first time in 2 years. It's a cool little chart here. You can kind of see this is healthy. They're going to zigzag, all the way back and forth. What I would say is what this is allowing, though, is it's going to let people get into the market. Some selling concessions are going to be more prevalent. And that's really what I like to see, is the ability to get people into the market. That's what home buying is all about, is affordability of getting in the market. You can see, 1 year price change per percent, kind of everyone's down, all the major cities. We're down here in the Atlanta market. You can kind of see it coming down. Tampa, Florida, that they're kind of getting back to the pre-COVID normal. Everyone moved to Florida because of policies of the governorship down there with the COVID. And so it kind of inflated everything, and now it's coming back. So this is a normal cycle, in my opinion, and it's going to allow more buyers to come to the market. Okay, now we're looking at some of the mortgage rates. They do dip during these periods, so it's positive short term and highly smooth, and it lags. But, I would just say the next couple of months are going to, from the Fannie Freddie to the bond market to the home pricing, there's just a lot of news going on. I would just say it all comes down to a simple fact of, do you need shelter or not? Are you going to be somewhere for more than 2 years or not? If you're going to be somewhere for more than 2 years, I always agree with buying a house. It's a hard asset. It will inflate with inflation. Renting does not inflate. So overall, hope you guys enjoyed this. But to wrap it up, I'd say the Fannie Freddie, it was always meant to go back to the public sector. Not too much there, as long as the implicit guarantee is still there. And then really the main thing to watch is the bond markets. The bond markets, that's what mortgages move off of. And it's very clearly written right down here is, the bond markets, we turn mortgages into bonds and sell them for a guarantee of repayment. If we lose the bond market, that will have the biggest impact on mortgage rates and everything else. So hope you guys enjoyed it.